the next minute or two. But to begin with, I just want to welcome everyone here. My name is Chris Call. I'm CEO of North Bay Credit Union. And joining me today for the presentation is Sandra Fontanellis. And Sandra, wave.
There Hi, everyone.
And she's going to help us with some of the topics. She's our lending department manager, and she has a significant amount of experience in the mortgage lending area, working for a number of institutions throughout her career. I have been involved in lending myself for about the past 35 years, both on a commercial basis and residential basis. And North Bay Credit Union has been offering home loans to its members for about 70 plus years. So we've had a little bit of experience in the area. And we're going to try to pass on some information today that will help you as you think about financing a home loan. And obviously, we're not going to be able to cover a lot of these topics in great depth, just because we don't want to overwhelm people. And also, we want to kind of keep it to the basics. So we'll give you an overview. And then if you'd like to follow up with any questions, please contact us after the meeting, or you can always pose questions in the chat box on your screen, and maybe we'll have time at the end to address some of those before we wrap up. Okay, I've got Bill Bagnall is on the call. He's our marketing person. He's going to be sort of monitoring the site and the call today. So if there's any technical difficulties, we'll get him on it right away. All right, so I assume you have joined us today because you are thinking of purchasing a home and thinking of what it's going to take to finance that home. And so we're going to walk through some of the areas that we as a lender will be looking for from you as a borrower. And hopefully that will help you better prepare for the whole process and make it easier for you to get your loan. First of all, it's probably a pretty good time to be buying a home, at least here in the North Bay area. Inventory is still pretty tight, but home prices are, they've been very strong as a result of the pandemic and people leaving the big cities, San Francisco and Oakland, to want to come to the North Bay, where it's a little bit less hectic, less urban, as long as they're working from home. So there's a lot of homes on the market and a lot of motivated sellers. So the thing that you want to do as you evaluate purchasing a home is start off by asking yourself how much you can really afford. What's the best amount that will fit into your own budget? And so to figure that out, the first thing you need to do is determine how much money you have for a down payment. And we're going to talk about down payment in just a second, but the down payment and your monthly payment capability are the two most important factors to determining the type of home that you should be focusing your efforts on. I would really encourage everyone to work with an experienced real estate agent in purchasing a home. A real estate agent can walk you through the lending process, can hook you up with the lenders, can help coordinate the documentation requirements. Really makes things a lot easier than trying to go at it through a sale by owner kind of situation. So you pay a little bit in commission as the buyer, but that money is well spent in the long term when you consider that they can protect your interests and get you the best deal possible. Okay, so we talked a little bit about down payment and monthly income. So you'll need to get all of your income sources pulled together. That means your W-2 wages from an employer. If you have income from any investments, you want to consider that. If you have things like alimony or child support coming in, that could be considered as well. Social Security income, disability income, all that is considered for your monthly housing capability or money that is available to pay for your housing costs. So you'll need documentation to supply for all of those income sources. One thing that you might want to consider also as you're thinking about your first-time home is getting into something that's going to be a good starter home, such as a condominium or a manufactured home or a townhouse kind of situation. These are good and sometimes more affordable alternatives than getting into a traditional suburban family home in a neighborhood. So I think what you want to do is get into that first home and let your equity build, and then parlay that gain in value to your next home. No one plans on staying in their first home for their entire adult life. Generally, we move for jobs or for other purposes. So think about how long you might want to stay in a home, and that's also going to affect the kind of loan you're going to be looking for. Okay, so once you've kind of figured out how much you can afford, and you've got a real estate agent and you're starting to look for homes, you want to get pre-qualified with a lender. Now, pre-qualified is a little bit different than pre-approval for a loan, because qualification just simply allows the lender to say, assuming all of the information that you've provided us is accurate, this is the size of the loan that you would qualify for. And then the approval process goes through a much more in-depth verification of those income sources and assets. And when the final loan approval is granted, then the lender is actually committing to making the loan. But under a pre-qualification, the lender is simply saying, this is what you would qualify for if you were to, if all this information that you provided to us is correct. So you can take that pre-qualification letter that you would get from your lender and incorporate that into your offers that you're making on your homes. And that will lend your offers some credibility and some strength, because the sellers are going to know that you've already been looked at by a lender and you've already been considered for how much you can afford and whether you're even in the ballpark for being able to qualify for the purchase of the home that you're looking at. Okay, so that's kind of the initial process. And now we're going to talk a little bit about getting your credit scores where you want them to be and how lenders look at credit scores and evaluating what kind of loans they can give. So I'm going to let Sandra take over from here.
Hi, everyone. So I think you've probably all heard the term FICO, your FICO score. And the FICO score is put together from 3 different credit repositories. One of them is TransUnion, the other is Experian, and the third one is Equifax. So any credit cards or any student loans or anything that you have will be reported monthly to these repositories. And there is an algorithm that makes FICO work, and it gives you your score. The good thing about FICO is that if you understand it, and there's ways for you to be able to understand it, you can raise it. So a good FICO score, or one that we would consider to approve a loan, has to be over 640. Now it goes anywhere from, I think, the 350 all the way up to 850. So it's in that range. If you're in the high 7s or the 8s, you're considered golden. That's a great score. But the high sixes, the low sevens, that's also considered a very good FICO score. And you really, really need to pay attention to your FICO score. You need to know what it is. You need to check it at least annually. And I actually look at mine once a month, just to make sure it is where I think it should be. And you can, I would be happy if anybody wants to email me after this. I can give you links to a lot of things that we're going to talk about. But the federal government ensures that everyone is entitled to a annual free credit report. And the site is annualcreditreport.com or something, but I can send you the link. So that's a good way to check your FICO. And also, generally, the higher your FICO score, the lower the interest rate we're going to offer you. So if your FICO score is a little on the lower side, you're going to be charged more interest because the lender looks at you as a higher credit risk. So as I said, there's a lot of ways that you can work on your score to bring it up, bring it back up where you think it should be.
And Sandra, some people haven't established any credit and may not have a credit score.
Right.
So in those situations, even if you're a renter and you're paying utility bills, there is a program, it's called the Boost program, that will go out and generate will help you establish a credit score. It will
Exactly.
take those.
Exactly.
Yeah,
Experian offers that. So just go on www.experian and just, look for the Boost program, and that will do it. And you can start small with maybe a Target credit card with a small limit. So there's a way to and what's critically important, of course, is, excuse me, that you pay your bill on time. So you can start, like Chris had suggested, with the Boost at Experian or with a small store card. And slowly over time, as you start to establish your credit, more and more credit card offers will come to you in the mail. But be discerning with those, don't sign up for all of them.
Yeah. Okay, so once you've got your credit score in hand, now you can start to think about making an offer on a home. The biggest hurdle for a lot of people is the down payment. Coming up with 20% of the down payment is a big chunk of cash for most people. So there are some programs that will help alleviate the need for putting out a lot of your own money. There are loan programs that only require 3% down payment. There's a veterans program that is offered through the VA administration, Veterans Administration, that allows a 0% down payment loan. And if you don't qualify for those, you can always work with family members to obtain a gift. Lenders will accept a gift from a family member as equity for the loan. Or you could even ask the seller to carry back a note. And oftentimes sellers might be motivated to provide a 10% loan in order to allow you to qualify to purchase their home. So there are those alternatives to the traditional 20% down payment that most lenders require. And why is it 20% down payment? It's simply lenders want you to have some skin in the game. And 20% seems to be an amount that most lenders feel comfortable with, that you're not going to walk away from your mortgage if you've got 20% of your own money tied up in that house. So any loan amount that's more than the 80% number is going to require private mortgage insurance. And if possible, you want to try to avoid that because it is fairly expensive insurance. It basically insures the lender from your default. It doesn't really help you at all. It just insures the lender. Sandra, anything to add there?
So PMI, yes, as Chris says, it becomes a component of your actual mortgage payment. But a lot of folks do need to get PMI or required to as just getting into their first home. But the good news with that is your lender or whoever ends up servicing your loan will give you the opportunity after a year, sometimes 2 years, to have the property reappraised. And here in California, we have the good fortune mostly of having the values go up. So you have your appraiser or an appraiser come out and reappraise, and the value has come up to the point where you are in that loan to value that's acceptable, and you can drop your PMI. So a lot of, again, you have to pay attention to what's going on with your mortgage, and that's how, in a year or two, you are able to get rid of that PMI. So that's a positive. You might have to pay it to get in initially, but it doesn't have to live with you.
Okay, Sandra, why don't you talk about what the lender is going to require from the borrowers to document and underwrite a loan?
Right. Okay, so particularly for first-time home buyers, it can feel a bit invasive, but it's all friendly. And again, it requires a lot of patience and a lot of understanding because we do need a lot of documentation. And it's a part of risk, and we need to know that we believe you have the ability to repay on this loan. And it's for consumer protection also. So we're going to need your W-2s from maybe the last 2 previous years. We're going to need some pay stubs. If you're self-employed, we can absolutely lend to you. We're going to need your tax returns, your 1040s with your Schedule C that shows, or if you have a corporation, we're going to need those corporation returns. So we'll need to establish that you do have the ability to repay this loan. We're going to require anything to substantiate your income. And then we'll also require that an appraisal be done to show that there's the value, and the amount we're going to lend corresponds with the value of the property. Pretty much, you can jump in, Chris.
So I just wanted to mention that for those of you who haven't purchased a home, the home buyer is required to pay for the appraisal.
Right.
And that's generally an out-of-pocket cost that you have to come up with. And those cost anywhere from $500 to I don't know, $1,500 on the high end, probably.
Right. We're also going to require assets. So if you have any 401k statements or any IRAs, savings account, bank statements, we're going to require bank statements. We're going to require checking account statements. We're going to need to see that there's some stability there and some appropriate behaviors around money. We're looking at, are you stable, and do you have the capabilities to pay this back? So besides the bank statements, the income statements, tax returns, and then you will be required to get homeowners insurance, and you'll have to pay your property taxes once you own the home. So that the payment can go into 2 different ways. You can just pay your principal and interest, and then on your own, you can pay your property taxes, which are due twice a year, and your homeowner's insurance. Or the servicer could set up what they call an impound or escrowed account, if you've heard of that. And what that means is that you pay extra in your mortgage payment. That goes into an account, and when those bills come due, the servicer will pay those out of the funds for your payment. Some loans require, the FHA and the VA loans do require that you're escrowed. So if you get that type of loan, it's a requirement. Some of the conventional loans don't require that. And it really depends on your situation. I've had mortgages personally. Sometimes I've had them impounded and sometimes I've paid them on my own. Just depends. So that's an important consideration.
Yeah, and to the extent you can prepare all of this documentation in advance and just bring it all to your lender in a big package, that's the best way to go, rather than having to go back and forth, something's missing. That just delays the process. And when you make an offer on a home, oftentimes there's a financing contingency clause that gives you a certain number of days to get approved by a lender. Generally, it's 45 to 60 days. They expect you to get approved for your loan in that time frame. And so to the extent that you have all of your documentation gathered together, ready to go, that will make it possible for the lender to work quickly and get you loan approval so that you can remove that financing contingency.
And everything that you provide to us is completely confidential. So it doesn't leave the desk of the person who's working on it. So who will work on your loan is your loan processor and then the underwriter. We have an in-house underwriter and that's it. So you can be assured of your confidentiality because that's important.
And then I wanted to bring up a couple of different ratios that you're going to hear in this process as you're talking to your loan officer. One of them is called loan to value, and that's the simply a percentage of your loan as a percentage of the market value of the property that you're buying. So loan to value is kind of what lenders look at to determine how much equity you're putting up for the property and how much cushion the lender has in the event that things go sideways and they have to take the property in as a foreclosed asset and try to sell the property. Then they would want to know that there's enough value there that they're not going to take a loss. So generally, the loan to value should be 80% or less. That means the loan amount is not more than 80% than the value, the market value of the home. And that's generally, the market value is determined by the appraisal or by the purchase price. So keep that in mind. And secondly, there's a ratio called debt to income, or DTI for short, an acronym. And that's simply all of your debt that you owe as a percentage of the amount of monthly income that you're bringing in. So that would include all of your revolving credit card debt, any obligations that you may have for student loans, any other loan or debt obligations for car loans, whatever. We take all of those debt and divide it by the total amount of income that you're bringing in. And we'd like to see that ratio be not more than 50%. So all of your debt obligations shouldn't be more than 50% of the money that you're bringing in income every month. Okay. 50% is actually a bit on the high side. And because we're making loans for our own portfolio in-house, we can go a little bit more aggressively on that ratio than you would see with a Fannie Mae or a Freddie Mac or a Ginnie Mae kind of loan, where the loan is being sold into the secondary market. They want to see those loan to debt to income ratios be more in the low 40s. So if you're working with a lender who's going to be selling your loan to Fannie Mae, they're going to want that debt to income ratio to be more like 40, 42%. Okay. So those are some the two key ratios that you want to be aware of. Now, I wanted to get kind of to the meat of the presentation, and that's what kind of loan programs are there available to first-time homebuyers. First of all, there's all kinds of different mortgage loan products out there. There's adjustable rate loans, or ARMs for short. there's fixed rate loans, there's balloon loans, there's interest only loans, all kinds of different loan options that you might want to consider. ARM loans, adjustable rate mortgages, are loans that start out with a fixed rate for a fixed period of time. And then after that time expires, then the rate becomes an adjustable or a variable rate loan that adjusts, say, once a year. Okay. So for example, we have here at the credit union, we have a 5-1 ARM loan. That means the rate is fixed for 5 years, the first 5 years. And then after 5 years are up, then the rate will adjust every year thereafter. And it adjusts based upon the index that the rate is tied to. And most times that's going to be either the prime rate or the LIBOR rate is often being used, but it's now being phased out. And there's some other kinds of publicly available market rates that are used to tie mortgage rates to. So a lender will establish a rate and then add or tie that to an index such as the prime rate. And once the adjustable rate period has expired, then whatever the prime rate is at that point will be what will determine your rate adjustment. Okay. Now, these ARM rate loans will often have caps and limits set to them. So for example, our 5-1 ARM loan has a cap of 2% in any 1 year. That means that the rate cannot adjust more than 2% in any single year. Okay, so if you start out with a rate of 3.5%, and 5 years from now, rates have gone up significantly, and let's say rates are now at 8%. Well, the most your rate could adjust to would be 5.5%, because that's only two percentage points, which is part of your loan note. It's what we agree to as a lender and you agree to as a borrower. And then also there will be a lifetime cap on those rate adjustments. Oftentimes it's about 6%. So over the whole term of the loan, the most it can adjust is a grand total of 6 percentage points. So in the case I just gave you in the example, if you started out with 3.5%, the highest it could ever get would be 9.5%. And that's even if rates were well above that. Okay. Now it works the other way as well. So if you start at 3.5% and then 5 years from now rates are down, then your rate could adjust downward as well. So we're currently in a very low rate environment. Rates have actually haven't been this low for decades. And so it's a really good time to borrow money and tie in a rate that's going to be with you for some period of time. Even as rates increase, then you're locked into a low rate. I'm going to pause there. Sandra, do you want to add anything?
The ARM product has gotten a bad rap in years past, but it really is a good way to get into a property. And you also have to say to yourself, how long do I think I'm going to be in this property? So a 5-1 that's fixed for 5 years, and you really think, I'm going to outgrow this house or I'm not going to be here, that's a good loan to get into. And then there's 10-1s and 7-1s. But rates are fantastically low right now for the 30-year fixed. And so as Chris said, it is a really great time to get into the real estate market. And, through the years, there has been highs and lows in the market, but it still is a good investment. Real estate is still, in my opinion, a good investment, and you build equity every month when you make your mortgage payment. So there's that to think about.
Okay, so
Sandra?
there's ARM loans that we talked about. There's fixed rate loans. You've all heard of a 30-year fixed rate loan. And that means you're locking that rate in for the entire term of the loan, 30 years. Generally, those long-term rates are going to be a little bit higher than an ARM rate because the lender is taking on more risk that rate is going to be profitable for 30 years as opposed to the risk of the rate only being profitable for 5 years. So there's a little bit of a discount offered on adjustable rate mortgages. There's also interest-only loans, which means that you're only paying the amount of the interest every month, and you never reduce the principal. And those generally have some sort of balloon payment at some point in time where you have to come up with the entire principal amount. Or it could convert into an amortizing loan at some point after 10 years or 15 years or so, and then you start paying back the principal. So there's all kind of creative loan products that can make your monthly payment amount affordable depending on what your income levels are. There's two things that are going to affect your monthly payment amount, and that is the rate. Actually, three things. First of all, the size of the loan. Secondly, the rate on that loan. And thirdly, the amortization term of how long you're paying it back. So some of you might currently be paying rent in which you're building no equity. You're simply paying a rent to a landlord and you're not gaining anything from that. Well, if you're paying on a mortgage loan, you're actually increasing the value of your equity every month that you reduce that principal amount. So as you amortize the loan, your equity increases. And oftentimes you can structure a mortgage loan to be less than what your rent payment is, depending on, again, these three factors that I just mentioned. If you, some lenders will even offer a 40-year amortization term, which would mean you're stretching the payments out longer, so the monthly payment is going to be less. Sandra, anything else to offer there?
I don't think so. I
Okay.
don't think so. But maybe just touch a little bit on the three major loan types that you can get into. And Chris talked about, so there's what we call the government loans, FHA and VA. So FHA is operated under HUD, Housing Urban Development, and it's a federal program. So FHA is a great government loan to get into as a first-time home buyer. The rates are lower and it's easier to qualify and you need less down payment. And of course, the VA, if you're a veteran, you should take advantage of those opportunities. So that's what we call the government, the FHA and the VA. And then the other type, which we do mostly here, but we're able to broker out for the other, is the conventional loan. And pretty much everything we've talked about is around this conventional loan. So there's, like Chris said in the beginning, if you align yourself with a very good, knowledgeable realtor, which is very important, and then partner with a good lender like us, then, you know, you'll be successful. If it's your dream to own a home, it will happen. You just got to get all the right people together.
Yeah, and as Sandra mentioned, having a good lender will give you the opportunity to evaluate all these different options and will help present you with different scenarios that you can consider. You don't need to be an expert in any of this. If you're working with people who are experts, then they will walk you through it and make sure you're comfortable with whatever decisions you make. So we want to make sure that our members are taken care of and have the best possible resources available to them. So it's important to us as a lender to make sure you're not getting in over your head. You're not biting off more than you can chew, but you're also getting the home that you really want and love. There was a quick question about loan servicing that I wanted to address quickly. You've all heard that lenders sell off loans, and you start with one lender, and the next thing you know, you're being asked to send your payment to some place in Trenton, New Jersey, or wherever. This is because lenders will originate loans and then have other different companies service those loans. And that's done because servicing loans requires some expertise and resources that a lot of lenders don't want to invest in. They want to just originate the loans and allow somebody else to collect the payments and deal with the escrow payments, deal with the mortgage or the insurance and the taxes and all that. So that's why you get the letter in the mail saying that your loan has been assigned to some other third company that you've never heard of. Okay.
It's not a negative. It's just what's done to everybody.
Sandra, can you talk about what do those last 48 hours look like before a loan closes? I think that's what everyone always thinks about, like those 2 days before the loan's closing. What does it look like? Tell us, be honest. Give us the inside scoop.
Sure. There can be some heightened anxiety. It's when everything needs to come together. So whenever you're in a purchase situation, you're going to open escrow. You've heard this term, with a title company. So it's your lender, your realtor, the buyer, the seller. Everybody's working in tandem to make this closing happen. So the underwriter, the loan will get processed, and the underwriter will condition, that's the term, condition for the extra documents or what they don't feel they have to completely approve your loan. And you receive your conditions, you get those conditions back into us, the lender, and the underwriter will approve. Then your loan documents are drawn, and then you have an appointment at the title company to sign your loan documents. And when that happens, you're almost there. It's almost done. So after the documents are signed, then the lender will fund your loan. And once your loan is funded and the deed is recorded, then you are the homeowner. There can be a lot of scrambling in the last week or last 3 or 4 days, but that's just typical. And title company expects that. We as the lender expect that. Your realtor, get a good realtor that can really make the difference in how quick and how smoothly your process goes. And of course, you have us as your lender.
To clarify, when you say conditions, you mean like we need 1 more year of this statement, and we need 1 more.
Yes.
So that's what you mean by condition.
Yeah.
Is that
and
correct?
Typically by that point, we do have everything, and we've income qualified you. Maybe usually what it is we need the homeowner's insurance policy that names us as the lender loss payee. So usually it's something that's not important to the core and structure of the loan. It's just like another little document that's needed. Because by that time you are generally 100% approved.
And when you go to that loan closing, there'll be a stack of documents about this thick that you'll have to sign dozens of pages.
You'll have received copies of everything ahead of time, correct, to review?
Yes.
Yes. I think that's important, don't you think?
Yes, you'll get an email either from title or from your lender with the set of documents. And it is important to understand exactly what you're getting into, and there just never is a wrong question, or you never can ask too many questions. You just really need to ask. If something's not clear, you should get the answer to it.
Sandra, I have another question for you. I'm a few days from close. Let's say I'm a week from closing on my dream house. I decide I'm going to go to Macy's and I'm going to use my Macy's card. And I'm going to buy a whole house worth of furniture. Bad
Yeah,
idea?
so we're
Bad idea?
gonna tell you, and we're gonna send you a notice that says, please, while your loan is in process, while we're trying to get this purchase through, do not incur any additional debt. So, whatever you need to do, don't go buy that new car. Don't incur any additional debt while your loan is in process. And, we can close loans in 30 days. So we're not asking for that. Sometimes it'll go 45, sometimes it'll go 60, but keep everything as is. And yeah, because that could be a problem. The other thing is, don't change jobs, or God forbid, lose your job, because one of the last phone calls we will make is we will verify employment on the day of funding. So that's the kind of, but that's a rarity. Somebody will let us know that they've lost their job. Or don't change jobs. Let your loan close, then change jobs.
Lindsay, you're on mute. You want to unmute? There you go.
Yeah, thank you. So once you're in escrow, the seller is no longer going to entertain other offers, correct? It's like a safety zone.
That's correct.
Okay, great.
Yes.
And then for the FHA loans, would we work with our lender on that piece, or is that a separate process?
Yes.
Okay.
Yes. And so what we would do in that, if you were interested in FHA, is we work with what we refer to as TPOs, which is third-party originators. So there are other brokers that we would refer you to that do those type of loans. But, as far as I'm concerned, if you started here with us, I would help you, as would the lending team, with whatever you needed.
Okay, great. And say you are working on an FHA, so that because you maybe have less for a down payment available and you're more in that 3% to 5% zone.
Right.
How does your monthly income play into that factor? Because if you're sort of giving less for the down payment, your loan is probably larger, and which means that maybe your monthly payments are higher.
Right.
So does your monthly income need to adjust to that?
It does. So what FHA, they have their limits also. I don't know exactly what their DTI is, their debt to income. I know that we use 50. I'm not, but I could look into it for you before you went further on it. But
Pretty sure it's 42%.
42. Okay, that sounds about right. So, you all remember the mortgage meltdown back in 06, 7, 8, 9. And what came out of that mess was that lenders are acutely aware now of making sure they don't get their borrower into something they can't afford. And that is really set the tone for lending today, because back during that time, lenders, not us, but lenders were putting people into loans that there was payment shock. They just couldn't afford it. And out of that sprung these big government agencies, the Consumer Financial Protection Bureau and all of that, to protect the consumer. So it's good that you're looking to purchase in today's world, because the consumer is much more protected, and you won't find yourself in something that you can't afford.
Great, thank you.
You're welcome.
Okay, well, we've been going now for about 45 minutes, and we've covered kind of the basic things that we wanted to touch upon. There's obviously much more depth that we could pursue if we had the time, but I think we'll hold off. And if any of you have questions that you'd like to pose to us offline, Bill, if you could post our email addresses in the comment box, Chris and Sandra at northbaycu.com. We're available to you at any time. We work with lenders or borrowers of all stripes and income levels and situations. And we're happy to help you through the process in any way that we can. So please come visit us or give us a call.
Or email. Be happy to answer any questions and help you get started. The credit union is a great place to start because we are less stringent than the lenders that Chris was saying, like sell to Fannie Mae, and that we portfolio our loans. So we're able to provide that special service and, really, really help you out. And
since Lindsay's on the call, I'm going to give a plug to our new alliance, where Lindsay's part of the California Cannabis Industry Association, and many people who work in the cannabis industry are unable to get home financing because of the nature of their employment. A lot of lenders will not accept salaries that are paid by cannabis companies as a source of repayment for the loan. That's not a concern to us. We're happy to work with people in the cannabis industry. As long as you can show that you've got a stable job, come talk to us.
We're very grateful for that. Thank you.
Okay. All right. Well, listen, I appreciate your participation on this call today, and hope your home buying process goes smoothly and well, and that you're all able to find a place that works for you. And let us know if we can help in any way. So thanks again, and have a good evening.
thank you. Good night.
Thank you.
Thanks so much.